right. Good morning. Good morning. Good morning. This is Mr. Not Advice. This is my weekend update. As always, this is for entertainment and education purposes only. We had a lot going on this week, obviously driven by the rolling, what I call rolling margin compression or PE compression among AI centric stocks. Before I get into that, let's take a look at the weekend review. We've got a lot of stuff to go over today, but let's take a look at that first. So, as I said, all charts are courtesy of Zero Hedge. Um, they have just fantastic charts. So let's take a look. So yeah, AI disruption continues as we saw multiple sectors, industry sectors get hit this week. But uh, against that backdrop, though, underlying, we had sort of like a Goldilocks scenario in the macro and fundamental part of our data set in the economy, which we had a stable labor market, we have a slowing inflation, and then we have solid growth from earnings. So it's not as bad as everyone thinks it is, but right now it's a very volatile period. I was making a comment to our traders that there has been the ongoing complaint from me and for all of us that we're bored. And I think if you are sitting there and you are bored because there's no trading to do, that is one of the best signs that you're a professional trader, because professional traders know when to stand aside and sit on their hands. Retail traders have to do something every day, and I'm sitting in a cash position right now, even with my EOSE exposure. I'm sitting in a cash position of about 70%. So I feel very, with the market the way it was, I can sit there and be bored, but I also know that traditional investors typically are fully invested and they're watching their accounts go up and down and just get hammered, while my worst emotional state is boredom. So boredom that switches to humor once in a while. So let's take a look specifically. This we had private. First, we had software as a service get hit, then private credit, then we had insurance brokers, financial brokers, and wealth managers. Uh, that was on Tuesday. Then we had real estate services stocks get hit on Wednesday. And then Thursday, it was logistics stocks as investors continue to follow the bouncing um, ball of destruction and freaked out over each sector's vulnerability to AI, the AI spend, the uh, AI application and tools that apparent or that will disrupt countless industries. We had the CEO of the head of Microsoft's AI department saying that within 12 to 18 months, there will be no white collar jobs. I don't believe that. I saw a great meme that said, in response to that, also within 12 to 18 months, Hot Pockets will replace all food in the world. So let's, when you hear these incredibly bearish statements or even bullish statements, it's always good to step back and provide context. So yesterday, despite we had a bounce yesterday, but all U.S. majors ended the week lower for the week. So, but when you put it in context, it wasn't like we saw this huge drop. It was for the week only a 1% drop. It humors me, annoys me to see people on Twitter, so-called gurus, saying, "Oh, this is setting up for an '87 style crash." They're wrong. It is not. And the other part of that is they just don't have the experience, right? If you've only been in the market for 10 years, you haven't seen a full market cycle. And quite frankly, you've never been in the market where monetary policy has not supported the bullish or the long end of the market. So yeah, you're not a baby in the market, but you certainly are. Your experience level, the context in which you look at price and market action is not broad enough to be able to make those types of statements. And I'm going to back that up with there is a single data point that I watch to see if there's stress underneath the hood. And you've seen me use this before. I'll show you this in a little bit. So the S&P 500 lost its 50-day moving average, but found support at the 100-day. So what's going on? This is going to be the battle zone right here between these two levels. The S&P, I have no interest in getting long the S&P and generally the overall market, except for some macro trades that I'll have a little bit later in this presentation. But I have no desire to get long the spark until we break out of this channel that we've been in and ultimately close above the 7,000 level on the SPX. So, okay, taking a look at the NASDAQ tried multiple times to get back above the 100-day moving average. It will do it. I think there's going to be a very quick and violent rally in the NASDAQ. I think it'll be short lived. I'll get to that in a little bit. But for now, the Nasdaq's, we don't know. I don't know if we are done with the rotation of death. I don't know which industry is next to get hit by this concern about vulnerability to software as a service. So, okay, so what do we have here? This is what could be the beginning of a short squeeze. Although, I mean, we had one, but it didn't last. But this is a software as a service, most shorted stocks. And there was the beginning of the short squeeze today, but it didn't last. I think there's going to be one that lasts. Now, when I say that, I'm not saying you're going to see price action go straight up. You're going to have pullbacks as uh, because there'll be profit taking. But I do think the most shorted baskets of stocks is going to rally. And I think there's a number of things coming up in the next couple of weeks that lend to perhaps it being a quite fast and powerful rally into the market or into the next few weeks. Uh, Software as a service stocks ended the week, oddly enough, unchanged for the week. I do not think we are done yet. We'll have to wait and see what happens with the holiday shortened week next week. As I was explaining to my members, this is PE compression. So you have analysts and investment banks that assigned higher than normal PEs to this entire sector, and then ancillary and related sectors. And now what they're saying effectively is, hey, we don't see the growth. We see growth, but we can't get a firm picture or an estimate of what that growth is going to be in terms of earnings, compression of expenses, so higher margins. And we don't know for some of these companies how they're going to compete in this new environment. So they have to bring their price to earnings ratios down. And the quickest way to do that is to drop the price. That's why we saw that type of price action move from sector to sector this week. Okay. One of the things out of Goldman was that fatigue has set in amongst professional traders, which that's probably why we had a calmer end to the week. Not anything to the extent that we're out of the woods yet. I think people are tired. I know that boredom for me, if I was in the market and heavy these stocks, I would be exhausted because of each day it was a new sector getting nailed. So mega cap tech plunged now down 4 days in a row at its lowest level since September the 5th of 2025. We have NVIDIA earnings on deck. I don't know if they will be enough to move mega cap tech back into a leadership position. And in fact, Mag 7 stocks this week were just a complete shit show. This is extraordinary to me that the Mag 7 has now underperformed the S&P 493, the other 493, by 10% year to date. That is just wicked. That is a wicked dispersion, demarcation between the two. And I don't think that we're quite really even started yet with the real sell off, which I'll talk about in a little bit. Amazon is down for the ninth straight day today. It's its longest losing streak since 2006. And this price action filled the gap from back in May of 2025 right here. Why? Well, Amazon announced massive capex spending in the last earnings, and I think this is a reflection of the uncertainty of when all this capex spending into data centers and AI is going to start providing positive gains to the company. So, if the analysts typically think out 3/4 or a quarter to 3/4 ahead, and there's just lack of visibility. I think it comes down to, hey, we know that there's going to be
a benefit, but when is the benefit going to hit and what is the benefit going to be? Yes. So alts and BDCs were again this week lower. BDCs, remember, are those companies that are business development companies that lend money to typically earlier stage, higher potential growth companies, in this case, software, as well as AI. So we're seeing a re-rating of those companies too. The concern is that we're going to start seeing loan defaults in the software as a service sector for the smaller companies or even mid-sized companies. I don't know if we're there yet. I think eventually we will, but I don't think we're there yet. Okay. Let's take a look. What do we have here? Oh, yeah, defensives. So, what I look at, one of the things I look at is what do I see with bonds? Bonds is the the huge market in the world, are oftentimes the canary in the coal mine. Look, I'm seeing bonds yields go down, not up. And so when I see that, I don't see stress. Just one of the data points I look for that there's not stress underneath the system. If there was, what would happen is the more conservative investment of bonds, if there was really fear and risk, you would have bond investors demanding a higher premium or higher interest rate in order to lend money. I'm not saying that. Okay. However, one interesting correlation that I wasn't aware of was that cyclicals and defenses, um, commodities, are trading with bond yields right now. And so we're going to need to see an uptick in bond yields. But here's the problem: if Warsh goes in and does what Trump wants and continues to lower interest rates, oddly enough, that would put pressure on commodities. Yes, because as yields go down, right, the bid for, let's say, the demand for safe haven investments would also go down. Now, there are many different cross currents that affect commodities, okay? But generally speaking, on a traditional basis, if you see weakness in the commodity space, it's going to be probably due over the mid and longer term to seeing yields come down because of the US government's stated goal of driving interest rates down on the back of really actually pretty good macro news coming out, both inflation and jobs picture. We have rate cut expectations now soaring for 2026. However, one of the things we need to keep an eye on is the March rate cuts, the red here, are completely off the table. Okay. April rate cuts, probably not going to happen. And it's probably going to be out to August or July or September before we see the first rate cut come out of the administration. Again, that is what the interest rate market is projecting, but we don't know. Warsh may take his first day in office and start cutting rates. Also, make a note that he made a comment this week that there might be the need for the Fed to adjust the flat line or the inflation target that they have by as much as a half to 1% higher. So it appears as though Warsh is leaning towards allowing the economy to run hotter than has been traditionally allowed throughout the Fed. I think that's a fantastic idea. So why is 2.5% inflation such a big fucking deal? I would be fine even at probably a 3.5 to 4%. And obviously as you start moving up above, 5 and 6, then I could see them creating inflationary pressures that might get away from them. Okay. It is a balance, right? And that's why I'm not the head of the Federal Reserve. So I mentioned earlier on, there's really one data point that I watch to see or to gauge if there's truly stress underneath the system. Okay. And that data point is very simple. It's bond volatility. And I don't see any. That's the green line here. This brownish line is software as a service stocks. That's obviously where we're seeing a tremendous amount of bond volatility. And until recently, we were seeing record levels of gold volatility. And that now has finally started dropping off. So across the board, I see no stress in the system because the bond market is the granddaddy market. I mean, it is huge. And that's the first place to look for if you are a doomsdayer and predicting that the market's going to crash. So, yes, every single person that's on Twitter that's calling for a market crash doesn't know what they're talking about. It doesn't mean I don't like them, but they don't know what they're talking about. Okay. All right, let's take a look at this. Commodities, as I said, they're going to be linked to treasury yields, and commodities also were down alongside treasury yields as they continue to drop. Why would they be dropping? Well, the macro picture is better. We've got subdued inflation. We have unemployment, um, also pretty flat. And so the market's taking that to mean that it's not running hot, so there's no need to be looking at raising rates, so there is room to lower rates. Yes? Okay, this is something that I pay attention to. You hear me talk about it a lot in terms of my end of the day reports. I want you to remember this number, there's 67 here, okay? 65 ish, 60, 66 is 67. But this is where dealer gamma flips. We are in positive gamma environment. What does that mean? Well, you can see this spike here. That's 7,000. It's going to take a shit ton of money to drive price for the SPX to finally break out and close above 7,000 with this massive SPX call wall. And I'll show you here when I get to the option ladder how massive this amount that's sitting there. On the other hand, this 66 to 6,700 is when there will be a flip to negative gamma. So positive gamma between about 66 to 7,000 is a massive amount of gamma. That means any rallies in a positive gamma environment, rallies will be sold, dips will be bought. However, underneath where this happens, we flip the negative gamma. What does that mean? Well, rallies will be bought and dips will be sold. So if you're looking at on a shorter term basis, 30 days out, it's going to take a lot of money to push it through 7,000. So the easier path is the market dropping further. And that's what dealers are doing, okay? Or that's the perspective that S&P dealers are taking. I don't, it's going to take something, and maybe it's Nvidia, I don't know. And we're going to talk about what the calendar looks like next week because I don't see there are a couple binary events next week that could drive it through 7,000. But again, this is a purely a mathematical equation. While the phrase "shit ton of money" is not mathematical, just it's going to take a lot of buying to drive us through and finally close above 7,000. Let's get back to software as a service. So while we had software as a service just get smashed, that's the red, right? IGV is your ETF that tracks software as a service, but infrastructure software. So that's software that is not as sensitive to AI. It didn't drop as much, right? So I'm not saying it's time to buy, but I'm also saying, look, this is not the Armageddon that some people are calling for in software as a service. It's also not the time to buy, according to me, according to my opinion, anyway. All right, let's dive. Let's look underneath the hood here. So, I'm always talking about money flow and order flow and all that good stuff. Well, one of the other important things is look at net exposure to a particular sector or a particular industry whenever you have volatility in the market and see what the change has been. So we've seen obviously this is hedge fund net exposure to software as a service stocks. And um, it's almost at zero. They are, I mean, it's just extraordinary. It's almost a zero. And that's something that, I mean, is for as long as I can go back in my thought process or my experience, software as a service was the sector that sort of was this boring, always growing sector that you could just sort of put money in and allocate to it and not really have any concerns about it, right? When's the last time you heard of Armageddon coming because of the software industry, right? So, gross net exposure to software as a service stocks also not quite at zero, but also record lows. Okay, so we've got the index performance and earnings of software as a service stocks. Here's the problem. So while the performance of the stocks as of recently have been pitiful, look at the 2-year forward earnings consensus. This is going to come down. This will go up. But this number, there have not been massive adjustments yet in the outlook. That is going to be another hit to software as a service stocks. When does that happen? Could be in the next earnings, end of the first quarter. Companies could start doing that now, but I think that's going to be the next hit to the market, especially the software as a service market. Oh, yes, this is the 15-year. There was almost a near perfect correlation between the NASDAQ and IGV, which is the software as a service ETF. Well, that's not happening anymore. And it's the widest diversion on record. Important. Do not look at this and say, well, this will just, because we had 15 years of trend, this is just going to close. So I'm going to jump back in. No, 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 no. It's an entirely different market than it was in, I don't know, 2017, okay, 2010, 2021, 2024. It's an entirely different macro outlook for these companies. And there is a tremendous amount of uncertainty in terms of, as I've been preaching, outlook. So don't try to bottom fish this thing based on the expectation that this divergence is so massive and that it has to close. It doesn't have to close. It could set a new paradigm and how IGV trades with the NDX. Okay. All right, here we go. IGV is at major support. How do you look at this? Well, some people may say, I'm going to get long here because this support is holding. Any retrace, by the way, that you get, the first area would be from this peak to this low. If it doesn't get above the 50% range, that's a dead cat bounce on a very short time frame. I don't think software as a service is done going down. Okay. Why? I just showed you that the earnings outlook for the next 2 years is still probably way too optimistic. Yes. So I don't think it's going down, and I think any bounce should be sold in software as a service stocks. Okay, taking a look at this data point here, I think this sets up for what I'm going to say later in this call. This is an issue. So hyperscaler CapEx is projected to reach 92% of cash flows in 2026. What does that mean? Well, they sell a product, they pay their expenses before they pay taxes and all that good stuff. You have the cash flow. Oversimplified version, obviously. If you're a CPA, I know that. But they're using 92% of their cash flow to fund capital expenditures for AI. This will not last. It can't last. At some point, the capital markets are going to be say, enough. Yes? Are we there yet? I don't think so. But we are getting very close. The Mag 7 stocks are in a technical correction, by the way. They are now down more than 10% from October highs. Is it time to jump in? I don't know. But I don't think that any bounce is going to be long lasting in the Mag 7 stocks, and I'll get to that in a bit. Okay. In addition, the Mag 7 index has fallen back to range lows and is now trading just above its 200-day moving average. The 100-day, however, what do you see here? It's starting to roll over. That's not a good look technically. Yes. And so if Nvidia might save the day, so to speak, but will Nvidia's earnings be enough to punch through here and finally break the Mag 7 out of this just annoying range? I don't think so. It might be able to do it for a day or two, but ultimately I don't see it happening where it's long lasting. Okay. I don't know what the hell's up with this chart. This is in terms of hedge funds positioning, both on the net side and the gross side. We're seeing meaningful selling in the Mag 7 by hedge funds. This is not just selling due to overall volatility of the market. Hedge funds have really meaningfully reduced their overall exposure. How much? Well, net exposure has gone down from 24% to 18%. How much is that? Well, 25%. That's a 25% reduction. That's a big time reduction in terms of the amount of capital that hedge funds had deployed. What does that tell me? Well, that tells me that there's a lot more cash that if there is a rally or when there is a rally, that money will probably flood back in, probably to this sector. I think any rally is going to be a sucker's rally, by the way, and I'll get to that. Okay, this is the problem. We've got hyperscalers are raising debt to finance exploding capex level. We got Oracle, Meta, Alphabet, Amazon, and Microsoft. And this is becoming more and more of a concern for investors. Because what do investors want to see on their investment? A return on investment. They want to make money. And in lieu of that, they want to see that there is a clear path to them making money. And right now, there is not. That's why we're seeing this underneath the surface rolling bear market in the Mag 7 stocks. It doesn't mean they're going to zero, but it does mean, I believe, that there's going to be further price adjustments within the Mag 7, within the AI theme, as well as the software as a service. One of the things I'm looking for is, I keep an eye on order flow or money flow, and retail demand is going to start falling into tax day. So, because typically what happens is you get money uh, pull up from the market for people, individuals to pay their taxes. Now, I was on a one-on-one with a member yesterday. And I said, I don't know how much the historical trend of that on a calendar basis going to hold up this year, because my understanding is that people are going to, on average, I think the average US taxpayer is going to see $6,000 more in terms of a refund this year. So I don't know if this is going to hold as strongly or not, but we've certainly seen retail demand for stocks drop off in the last 3 weeks, uh, which is entirely understandable with the market action. Yes. Okay, so let's look at some individual stocks here. One of the things I like to do is, while I use the daily entirely to trade, okay, I like to look out at the monthly or the weekly, because it gives you an idea, that 60,000 foot perspective of what's really going on if we step back with, all the, the daily mosh pit of price action. It's pretty easy to see here. Remember, I was calling out that 67 under level. Price and the S&P 500 has just been stuck there. Yes. And then if we go over to the NASDAQ market, same thing, people. Price has been stuck right above that 24,000 level to 26,000. I'm using rough numbers here, but price has been stuck in this channel for 4 months now, right? And I think that any rally, unless we break out to all-time highs and hold, should merely be treated as a dead cat bounce rally. Okay. Let's take a look at. We did have a couple trades this week. It was interesting. We had a trade in Campbell's Soup this week. So we got into Campbell's Soup on no Tuesday. And yesterday morning, look what happened. We had at the open yesterday this candle. Wicked. Huh? So what did we do as traders? We sold. We scaled immediately. Okay. And as it was coming back down, we closed the position. Quick, very quick trading, right? Not normal. Typically we were able to hold positions much longer, but when this happened, I did my first scale for 50%, 50 of my position. And I think I got 36 or 37%. And then when this happened, I was telling my members, watch for the rollover. And as soon as it started to roll over, we exited. And I think I netted out for all that hard work. I believe I netted out approximately 25% for the trade. Not great, but I didn't put on a lot of trades this week. So my portfolio for the last couple of months hasn't really moved. And I'm going to continue to do that because what? Risk remains high. Looking at some of our favorite stocks, let's look at EOSE. EOSE did announce that they're going to come out with earnings earlier than usual. And I was asked, do we think that this is a tradable bottom? Well, you've got a binary event coming up. I don't think a lot of this selling has been organic, meaning to the company or to the outlook for the company because, quite frankly, there hasn't been any update of news. So, how the hell would you adjust the price based on outlook? There are those worry words out there that are selling or bitching about it on Twitter. We want a news release. We not want a news release. Well, it doesn't really matter what you want because investors are the flea on the tail of the dog. Nothing has changed. There's no additional new fundamental or macro data until they release earnings. And I'm not smart enough to prognosticate on what they could possibly come out with earnings. Other than the fact that I still think it's a chance that if they miss fourth quarter earnings, I don't care. I mean, literally, I don't care because I'm looking forward. I want to hear about what their next month, 3 months, quarters through the end of the year. Um, I don't know if we are done going down. And I do think that we're probably going to see well, let's just get to it. Okay. I think there is room for a short covering rally across all the indexes, especially in the small cap. Okay. Because the Russell 2000 short interest percentage is at is almost at an all-time high. You simply, with that many shorts positioned, you're going to get a wicked short squeeze, and that could drive the price of EOSE above 15. Now the question is when. I don't know. I'll know it when I see it, right? Additionally, what do we have that's going to help the S&P 500? By the way, well, we have the lowest period of corporate buybacks this past week. And then this coming week, and then for the next 6 weeks until the end of March, we're going to have those corporate buybacks turn right back on to 30 to $50 billion per week over the next 6 weeks. That is going to help flatten out, smooth out, reduce this volatility in the market. Because corporations buy, they don't give a shit with their stock prices. They just go in and buy. So I think the next 6 weeks are a window for the market to rally, and then ultimately, I see destruction. And I'll get to that in a second. But this is EOSE. If we do get a short squeeze, I fully expect the EOSE to, I guess, rally at the same time. And how much it rallies or if that rally sustained, I guess it's going to depend on what they reveal in their earnings uh, report that is coming out now, I believe at the end of February. Yes, I haven't checked. I did open one new position, BORR. This is I think it's a shallow water rig provider for oil drilling. And they have, while a smaller fleet, they have one of the newest fleets. And so there was some M&A activity this week with Seadrill. So this is, in my mind, a natural possible takeover target. I have made money in this. I went out pretty far in it. I didn't add any new positions. As I said, if you subtract out EOSE, my only long position right now, ending this past week, is BORR. Yeah, I'm not long anything else. I would not expect any bounce. Well, let's put it this way: any bounce in the markets, I believe, should be sold. Okay, and I'll show you why in a second here. And I'm not going to go over any other charts because I sort of went over them on the broad market indexes. Uh, we've got a binary event this Friday coming up. I guess that the Supreme Court announced that they are going to issue an opinion on the tariff issue, and there's Polymarket's putting it at only 23% that the Supreme Court will rule in Trump's in Trump's favor. I have yet to see any type of positioning in terms of the futures market and options market in terms of how the market's going to read that. So I have already told my members that I will only enter new positions on Tuesday because I want to be out of them by that Friday morning announcement. Let me show you something here on the SPX on the call wall. So when you look at the option data, what's very telling is if you go down here, look at this 7,000 level. These are the amount of open interest contracts on the call side. Remember what I was saying, that's a massive call wall. It's is so again, if dealers are in positive gamma, okay, until you get above 7,000. What does that mean? As price continues to approach 7,000, because dealers have so much positive delta and it will go up, right? And hedge funds, CTAs, what do they need to be? They need to be neutral delta. And therefore, they're going to be selling into this price level, which is what they've been doing, unless you get a trigger event that will push it over. Could be a short squeeze, right? I don't know yet, but this is right here a massive wall that the S&P 500 has not been able to get through, and I don't really think it's going to get through there anytime too soon and hold. So I have no desire to size up my positions or even trade anymore. I mean, look, shit, I'm right now at, not including EOSE, effectively, I've got 98% cash. You throw in my EOSE position, I'm at, what did I say, 75% cash? So I'm not sweating the market. I'm sitting here watching, protecting capital, which is my number one rule of trading. Okay. And just waiting. So this is my plan, something new this week. This is what I plan on doing. I think we're going to get a short squeeze rally. That's going to be driven by corporate buybacks and record short positions. I think that starts next week. However, it may get somewhat neutered by the tariff decision. It's not going to be a straight shot up. As I said, tariff ruling next Friday could speed up the next step. I then ultimately think semis crash when the first mega cap company announces that they're going to pause their AI capex spending. I think semis crash as much as 50%. And I also think that the Korean stock market is going to crash, really 30 to 40%, because they have been rallying so much on their semiconductors. So, what am I going to do about it? Well, I'm going to wait and see what happens this week on a short squeeze rally, if we get one, right? Corporate buybacks, record short positions. If we're able to, and the trick is going to be not for me not to get obsessed with calling the top. Okay, this is going to be a very small position, right? I'm going to take a 2 to 4% position in this maximum. I'm going to go out 6 months minimum, and I'm going to take short positions in both the SOXL as well as the Korean stock market. Yep, I'm going to do it. And this, I think, is inevitable. There is no way that mega cap, there is not a mega cap company who is not going to announce a pause. I could be wrong and I could lose. That's okay with me. It's a small position. So I think the market is long, then short. And then after this happens, after semis crash, I think that's when the real longer term rally is going to begin. And if I had to time it, June, July, okay, right in time for what? Midterm elections, right? So I'm going to go small position short the KOSPI and chip makers via ETFs. I'm not doing it next week, okay? I'm going to wait uh, at least until after this whole tariff thing, right? Now, I know that I may miss part of the down move if the tariff announcement is what triggers the initial move down in both semis and Korean stock markets. So, this is as of today what my plan is. That might change during the week. I also think EOSC on this crash, which will drag down the entire market, by the way, is going to trade under $10. Okay. Um, unless they come out with just such banger outlook, for the remainder of 2026, that it becomes one of the few stocks that money flows into because the outlook is so strong and not associated with AI and hyperscalers. The problem is they didn't get any of the benefit of being associated with AI and hyperscalers, but they certainly got smashed for the fact that they have mentioned that, or there's a perceived perhaps customer demand from AI, specifically hyperscalers. So I do think that EOSC could very well trade under $10. I do not think this is something that is organic. And I would look at that to be a absolutely a tradable area. And I think it sets us up well in my mind. I think it sets us up well for the second half of 2026. It's very hard to look out and predict when specific events are going to happen. Okay, very, very hard. So I may even look at this week rolling my 27s into my Jan 27s out to 28, right? But I've got to look at the math. I got to think about it because I'd love to be able to do it on a short squeeze rally first. But I guess the simplest way to put it is, I think we're going to get a rally. I think it's going to be mechanically driven, right? Corporate buybacks and record short positions. I think the tariff ruling next week could go either way. Poly market says it's not going to be good for Trump, but I don't know how how the market's positioned for that. Uh, we're already in a technical bear market with mega caps, the Mag 7, first of all. But I think the real party begins to the downside when the first mega cap company says they're going to pause AI capex spending. That could happen at any time. So that's going to be a problem. One of the decisions and positioning in that is, while I have my time, I don't know because it could happen. Any company could announce that at any time. And so going short now the semis via the ETFs, you're gonna see an unrealized loss until and unless that happens. And so my macro trade between 2 and 4%, I've got to assume it's going to be 100% loss, right? Same thing for the Korean stock market. I have to assume and accept that that's a possibility. I don't believe it's a probability. Okay, so long, then short, then the real rally begins. All right. Well, I hope you all have a great holiday weekend. We have President's Day on Monday, so the market is closed. We have Friday's tariff decision coming. So I think next week, unfortunately, I think we're going to get some buying in the market. I think we're probably have a good chance of getting that short squeeze rally. So people will quote unquote feel better. But I do not think that that's going to last. So have a great weekend. Hug your family. And as I think it was Journey, be good to yourself. Instagram and tuxedos with my peoples. We growing up, still don't seem like we slowing up. 10 squad, we throwing up every time that we showing up. Get it while I'm living. All I ever hear is the clock tick, tick, tick.